Assalamualaikum warahmatullahi wabarakatuh. My name is Asmaul Husna binti Muhammad Jeffrey, metric number 263376. Okay, I will start with the first parts in our topic, which is the difference between the interbank and the commercial transaction. Firstly, what is the interbank transaction? Interbank transaction is the relationship between two banks through the transaction which is involve the different currency and mostly in the short durations, while the commercial transactions are relationship occur due to the type of payments for goods and services when two or more parties enter an agreement to exchange the item in the values. Next, we look at what is the difference between the interbank and the commercial transaction. Interbank and commercial transaction are being differentiated in terms of several elements. The first element is the main activities. The main activities for the interbanks is involving the buying and selling for the spot dealings, while the commercial transactions activities is buying and selling for the foreign exchange of the value same day or the forward days. The next one is the pricing. In terms of interbanks, the pricing are based on the interbank rates, while in the commercial transactions, the pricing are based on the commercial rates. The next difference between the interbanks and commercial transaction are in terms of settlement dates. Settlement dates for the interbank are according to the spot dates, while the settlement dates for the commercial bank can be any times based on the agreements that has been agreed between the two parties. The next one is the commodity trades. For the interbank are typically use US dollars against a various currency, while the commercial transaction normally use a foreign currency instead of local currencies. That the difference between the interbank and the commercial transaction. Then we move to the next parts in our topics to the next presenter.
Assalamualaikum and good morning. My name is Marina Shahira binti Amir Syakir 25. My metric number is 26298. I will continue with my part, which is hedging the net exchange position that created by trade. Trade is known as the basic activity of all investor or investment services. It is consisting of buying, selling, or exchanging the asset. Under the financial markets, people always trade securities such as share, currency, commodity, and derivative. However, the general aim of trade is to look for a profit by buying at a lower price and selling at a higher price within a relatively short period of time. Trading can be categorized as flow trading, online trading, equity trading, and currency trading. Besides, net open position in foreign exchange risk is the net outstanding balance of all assets, liabilities, and off-balance sheet items in that currency. However, the net exchange position is known as the position from its day's purchases and sales, both ready and forward of foreign currency. There are three types of position which consist of overbought, oversold, and square position. The first one is oversold position, which is known as short position. It is known as the sales of a day exceed the purchases. The next one is overbought position, which is known as the long position. It is known as the purchases of a day exceed the sales. Lastly is the square position, which is the purchases of a day are equal with the sales. The foreign exchange position can be either open or closed. It exists when the amount of the bank assets and liability are equal in each type of currency. The foreign exchange positions should be considered closed. Meanwhile, the bank amount of the bank asset and liability are not equal in each type of currency. The foreign exchange position should be considered open. Next, by referring to the types of foreign currency, a bank's open foreign exchange position can be either long or short, which when the bank asset exceeds its liability within the same type of foreign currency, an open foreign exchange position should be considered long. However, when the bank assets are less than its liability within the same types of foreign currency, an open foreign exchange position should be considered as short. Currency risk will be occurs when the net asset value is affected by the result of fluctuation between foreign currency and its home currency. Therefore, to minimize risk of currency occur, we should avoid all risk exposure. Reduce risk exposure to minimum through internal hedging. Hedge risk exposure, which decide on external hedging option, and lastly, take on risk exposure head-on. Trade financing is known as the financial instrument and product that are used by companies to facilitate international trade and commerce. Financial supply chain is referring to the technique and practices used by the bank and other financial institutions to manage the capital invested into supply chains and reduce risk for the parties involved. Each of the financial intervention, such as financing, risk mitigation, or payment in the supply chain, is driven by an event or trigger in the physical supply chain. Some example of the event is purchase, order, pre-shipment inspection, dispatch or shipment, invoice raised by the seller, and good accepted by the buyer or enter the buyer warehouse. Therefore, letter of credit is known as the financing. Letter of credit also known as the documentary credits. It is financial legally binding instrument issued by the bank or specially trade finance institution. Letter of credit guarantees that the seller will be paid on behalf of the buyer if the terms specified in the letter of credit are fulfilled. A letter of credit requires an importer and exporter with an issuing bank and potentially a confirming bank, respectively. The financial and their creditworthiness are crucial for this type of trade finance. The issuing and confirming bank effectively replace the guarantee of payment from the buyer, reducing the risk to the supplier. This is called credit enhancement. A letter of credit transaction generally happens as follows. Firstly, an importer agrees to buy goods from an exporter. It is called as a purchase order is issued. Next is the importer will approach an issuing bank, which is the trade financier, which will issue a letter of credit if the company fulfills the bank criteria. Thus, the exporter will work with the confirming bank who will request the letter of credit document be checked from the issuing bank. Next, the confirming bank will be checked the letter of credit, and if the terms are agreeable, the exporter will ship the goods. After that, the exporters then send the relevant shipping documents to the confirming bank. Once the confirming bank has examined the shipping document in strict compliance against the letter of credit terms from the issuing bank, they will forward this document on the issuing bank. Thus, payment will be made according to the agreed term, guaranteed by the issuing bank. The issuing bank then releases the shipping document so that the importer can claim the good that was shipped. Lastly, depending on the terms agreed, the issuing bank then transfers money to the confirming bank who will then transfer the fund onto the exporter. That's all for me. Thank you.
Hi, Assalamualaikum and good day for everyone. My name is Idros Ayu Bentino, metric number 262557. So, I will present my part, which is trade finance when order is received. So, for the first one, the function of trade finance is to introduce to a third party to transaction to remove the payment risk and the supply risk. So, trade finance provides the exporter with receivable or payment according to the agreement, while the importer might be extended credit to fulfill the trade order. Therefore, exporter want to receive payment as soon as possible, preferably as soon as an order is placed or before the goods are sent to the importer. So, importer want to receive the good as soon as possible, but to delay payment, preferably until after the goods are resold to generate enough income to pay the exporter. Okay, trade finance represent the financial instrument and product that are used by company to facilitate international trade and commerce. As we know, without trade financing, a company might fall behind on payment and lose a key customer or supplier that could have long-term ramifications for the company. We have many ways to do payment when order is received, such as open account and consignment. Open account is transaction, a sale where the goods are shipped and delivered before payment is due, which is international sales, is typically in 30, 60 or 19 days. Consignment, which is in international trade, is a variation of open account in which payment is sent to the exporter only after the goods have been sold by the foreign distributor to the end customer.
Hi, my name is Nur Ilya binti Muhammad Sokri with the number metric 262800. Okay, a hedging transaction is a tactical action that an investor takes with the intent of reducing the risk of losing money or experiencing a shortfall while executing the investment strategy. It is simply known as a risk management strategy that deals with reducing the uncertainty related to adverse price fluctuation in asset. Hedging is like insurance, where it is utilized to minimize the chance the asset will lose value while limiting the loss to a known and specific amount if there is a loss. There are two types of hedging technique. First is the natural hedging technique. It is involved changing something within the business or altering the financial structure of the business. The exposure is eliminated without actually needing to undertake further transaction. Second is the transactional hedging technique that involves various facilities provided by the bank or other institution such as future and option exchange. Common hedging product offered is such as foreign exchange forward contract, currency future, currency option, foreign exchange swaps. Let's go through the forward contract. It is a firm has to pay or receive some fixed amount of foreign currency in the future. It can obtain a contract now, then donate a price by which it can buy or sell the foreign currency in the future date. Second is the currency future. These are similar to the forward contract in function. Future contracts are usually exchange rate and they have standardized and limited contract size, maturity dates, initial collateral, and several other features. Third, the currency option. A foreign currency option is a contract that has an upfront fee and offer the owner the right but not an obligation to trade currency in a specific quantity, price, and time period. Last is the foreign exchange swaps. It is an agreement to exchange financial assets at a fixed date and price. Swaps are agreement between two parties who exchange currency at an initial moment, then usually send back small amount as interest and finally return the initial amount. Swap contract has a fixed currency exchange rate, so they eliminate the uncertainty about future market movement. Both parties know exactly how much local currency they'll get at the end of the deal. What is a perfect hedging transaction? A perfect hedging transaction locks in the future income stream for the asset you are holding and eliminates all risk resulting from the exposure. A future contract is an example of the perfect hedge. A future contract is a legally binding agreement to buy or sell something at a specific price in the future. So for example, if you are holding Ford stock that you bought at $10.50 per share and you take the sell side of the future contract for Ford in 6 months for $11 per share, you have eliminated all risk and locked in the future cash income. Now you are perfectly hedged. In 6 months, you will be able to sell the share at $11 a piece, and the other party involved in the future contract will be obligated to buy them at this price, regardless of the prevailing market price. As a result, you are protected against a drop in the stock's market price. Reminder, diversification is also another hedging strategy. What about imperfect hedging transaction? An imperfect hedging transaction reduces the probability of loss resulting from an exposure, but it does not eliminate it. In the real world, you cannot get a future contract for every share. Assuming you are holding stock issued by a small firm and it is impossible to lock in a sale price with a future contract, you can instead short the S&P 500 index share to partially hedge your exposure. Shorting S&P index share means that the lower the index goes, the more money you will make. So if the price of the stock declines because of the broad decline in stock price, you will lose money from your exposure to the specific stock you are holding. But you are probably will make some money from your short index position. This hedge is imperfect because your stock and the index might not decline in lockstep. Your stock could lose value even when the index is rising. Reminder, hedging is a technique utilized to reducing risk, but it's important to keep in mind that nearly every hedging practice will have its own downside.